All right, so Vanguard Dividend Growth Fund versus Vanguard Wellington versus the S&P 500, VFINX. This is fun. So I was doing some research on the various on Vanguard Dividend Growth Fund. I did a video on this earlier, but I wanted to actually throw in this morning what the S&P 500 did. Very, very interesting, actually. So I posted this on my blog at heritagewealthplanning.com. If you're part of my email, you would have got a link to this as well with some other notes I threw into the email chain. Actually, I just posted this right now. It's pretty interesting. When you look at your email, you can see you don't know who opens it, but you can see how many people open the email, and I get pretty good. Like we've already had 239 people open it, and 61 people have clicked on the link, which is pretty good. I get about 1,400, 1,500 people on my email list. So, after sending it literally 45 minutes or something like that, that's a good amount of people already doing it. On my email list, I average about 45% open rate, which is quite good. So I appreciate if you're on the email list being part of it and opening it. I don't know if that does anything and I have no idea how that works in terms of Google recognizes my website. I don't know. But at the end of the day, it's interesting stuff. So let's read this. And if you want, I'll put a link in the show notes here if you want to click on it. Believe it or not, by you clicking on this website and actually staying on it, there is something called a bounce rate. And I'll show you I know this is getting off topic. I'll get back on it here in just a second. So I look at my Google Analytics, and again, I don't know who's on the website or anything, but you can see something that's called, bounce. So you can see 78 people have clicked on this link today, and they've averaged been on it 2 minutes and 51 seconds on my page, on Heritage Wealth Planning page. That's actually pretty good. So that's a bounce rate of 84%. The lower the bounce rate, the better. And I'm not quite so sure that that's actually true. I mean, so basically, if you look at heritagewealthplanning.com, my bounce rate is 84%, which is on the high end. My homepage, the bounce rate is 38%, which is very good. So I don't know how that works in terms of what Google looks at it, but you can see like this right here has a 92% bounce rate, which isn't good, but yet the average time on it is 5 minutes and 37 seconds. So my understanding, if you're looking at doing website development or anything like that, is that a bounce rate, you want the bounce rate to be low, but you want people to be on the actual web page long. So in this case, I got a bounce rate of 92%, but they're averaging 5 minutes on this page, on this article, not this page. The page would be Heritage Wealth Planning. So what that means is that basically people are leaving they're reading this, takes them, on average 5 minutes to read, and then they go someplace else, not on my website, but on this page. And that's how Google Analytics does it to see your relevance in terms of whether or not they promote your stuff. It's actually incredibly interesting, I find. There's my Rick Edelman is wrong. That was an article. That was the average time on that page today was 2 minutes and 45 seconds. That's all good, man. That's all good. All right, so let's click on this. I'm not sure why the ads aren't showing up, and if all right, I don't know why the ads aren't showing up. All right, well, whatever. All right, so let's. I'm just gonna read and give you my exquisite commentary. The news at Vanguard. Okay, a couple other things. Just want me happening here. These are called headlines. All right, so this is the headline title, and these right here is a headline one, heading, I should say, heading. So this is the headline. These are headings. If you're doing what's called SEO, search engine optimization, you really want to try to put headings in here, and that's why you'll see. And you want to be headings that are relevant to the title and the article that you're writing about. But you also want headings that are interesting to people when they search on it. So if I go to my other website, because I have this set up, and I say, okay, what's Google? We're going to type, oops, sorry, buddy. We're going to type in VDIGX and see how many people search for that. Hold on just a second. That's searched for 6,600 times a month, according to Google. That's a pretty good search. So when I put this VDIGX, I think I put it down here again, that tells Google, hey, this article is about VDIGX. That's telling the Google algorithm, because there's no one researching this, it's literally just AI, that VDIGX is important in this article. Now, the problem is you want to make sure your bounce rate stays high, your time on page stays high, because if you write this stuff, VDIGX, and you're talking about butterflies frolicking through the park, no one's going to stay on the page very long, and Google is going to know that you're what's called keyword stuffing. You don't want that. So keyword stuffing is bad. You don't want, because then Google's going to penalize you for basically trying to fool the algorithm. And they're doing that a lot on YouTube as well. So that's, anyway, if you're doing any kind of website stuff, you want to have these headings about what you're trying to get across, what you're trying to protect. You also want to have, these aren't necessarily images, this is spreadsheets, but you want to have images, just other visuals to kind of break up the stuff. And you can see, and you also want to have a lot of white space in there as well. Now, look, I'm not an expert on this by any stretch of the imagination, but I mean, you're watching the video. You came to my video somehow, and you came to it from my SEO, search engine optimization. That's how you got here. And so it works, man. Now, for me, it's going to take longer because I don't put all that much effort and time into this. But if you want to get started, that's how you got to do it. You got to write, long blog posts, 5, 6, 1,000, 2,000 words for sure. Lots of different visuals in there if possible, and do the headings. And so let's see real quick. And I'm going to type in Vanguard Dividend Growth. Vanguard Dividend Growth. And that gets 1,900. Let's do Dividend Growth Fund searches a month, according to keyword researchers. So at the end of the day, and let's do Wellington, just one other thing here. Vanguard VWELX. And that gets Vanguard Wellington gets how much here? That also, so basically any Vanguard fund is going to get about 6,600 a month or so. That's not exact because that's not the Google keyword stuff, but I do use Vanguard Wellington fund. I do use a Google keyword too when I get in there. It's about 2,400 a month. All right, so that's a decently searched topic, Vanguard funds. So just keep that in the background. All right. So generally, I'm an index fund type of guy, but I do appreciate a good, actively managed, well-run, low-cost fund. American funds and Vanguard come to mind. I also appreciate the fund that limits the amount of assets it takes in. As per the Vanguard press release reopening the VDIGX. Vanguard closed the fund to most new accounts in July 2016, seeking to attract the interest of to protect the interest of existing shareholders by reducing cash flow coming in after rapid growth. Cash flow has subsequently subsided and market conditions have changed since the fund's closing. That VDIGX closed to new investors and is reopening tells me it will probably close again as they get more and more assets in there, especially if value does take off. This fund will be pretty big, and when that happens, they're going to close again, I would imagine, just like PrimeCap. And so I want to do some research on this fund to see if this fund I'd want to own. Disclosure, I do now own this. I bought it on Friday. I think I bought it Friday on my USA account, which charges me $45 to buy a Vanguard fund. So at some point, I'll just move my stuff over to Vanguard. Again, from the Vanguard press release. Introduced in 1992 May, the actively managed dividend growth fund is designed to provide investors with some income while offering exposure to dividend-focused companies across all industries. The fund focuses on high-quality companies that have both the ability and commitment to potentially grow their dividends over time. Reopening the fund will have no impact on its investment objectives, strategies, and policies, and Wellington Management Company remains the fund's investment advisor. All right, so it turns out this is an amazing fund, exactly what one would expect from Vanguard. In fact, $100,000 invested on January 1st, 1993, which in the inception was, I think, September 92. So I'm just going calendar year to calendar year. Would have grown to $730,000 by December 31st, 2018. The fund has only had 5 down years in those 25. So that's a pretty good hit. You got 20. It's a 25 record. That ain't bad, man. So not only did you make a lot of money, but you didn't have many down years either. In fact, other than 2001, when the fund was down over 19%, it was a whole lot less volatile than the S&P 500. For instance, in 2000, the S&P 500 was down 9%, where the Vanguard Dividend Growth Fund was up nearly 19%. In 2008, when the S&P 500 was down over 37%, Vanguard Dividend Growth Fund was down about 25.5%. But don't forget, the Wellington Fund was only down 22% in that 2008 time frame. And in those crazy years of 2000 and 2002, where both the VDIGX and the S&P 500 got knocked around a bit, Wellington had only one down year, and that was in 2002, where it was down 6.9%. So I thought it'd be fun to do a comparison between all 3 funds over the last 25 years. We're going to put $100,000 in each on 1 January 1993 and see how we did. And what we'll see here is interesting. VDIGX was down in 1999, whereas the S&P 500 was up 21%. VDIGX was down 2.96, and that's just because of value orientation of dividends. This is the last year of the tech boom. 2000, VDIGX was up almost 19%. Wellington was up 10.4. S&P 500 was down 9. And then you can see the next 2 years, VDIGX got killed, down about 20 and 23% respectively. Wellington got just stubbed its toe, down 6.9% in 2002, where S&P 500 was down 22%. Fast forward until 2008, the Wellington was down 22%. Vanguard dividend growth was down 25%, and S&P 500 was down 37%. But then if we look at what has grown to, the Vanguard dividend growth fund is up to $729,000 at the end of 2018. Not bad, but the Wellington's $958,000, and the S&P 500 is $966,000, with both the Wellington and the S&P 500 having taken down years last year. So I mean, that's almost $250,000 less in the dividend growth fund than the S&P 500. Now, I'll tell you, at that point, I started saying, why even mess with it? Why even mess with it? I'm literally saying that this morning, and I said, oh, man, that's nuts. $250,000 that left on the table. Well, and the reason for that is, let's look. And let's see, what am I looking at? Oh, that's in 1996, S&P 500 was up 20. Well, that's not that. I mean, yeah, I mean, just it has some bigger down years, some bigger up, and less bigger up. I mean, some had some down years that weren't quite as bad as the S&P 500, but not nearly to the extent some of the bigger years that the S&P 500 had for sure. But at the end of the day, the S&P 500 was up $250,000. But before you dump all your money into the S&P 500, you want to consider this: from 2000 till 2018. $100,000 invested in the Vanguard Dividend Growth Fund, Wellington, and S&P 500. Dividend Growth Fund grew to $332,000. Wellington grew to $380,000. S&P 500 only grew to $250,000. So basically, the Dividend Growth Fund more than tripled. The Wellington almost quadrupled, and the S&P 500 only was up by doubled, a little bit more than doubling. That's a big deal. I mean, that's $80,000 difference between the Wellington, $90,000 roughly different between S&P 500 and the Dividend Growth Fund, and $140,000 different between the Wellington and S&P 500 fund. But before you throw all your money into Wellington, because remember, after from 2000 to 2018, Wellington's at 380, and after 1993 to 2008, Wellington was only $8,000 off the S&P 500. So you might be sitting there saying, let me go with the Wellington. But watch this. So from 2008 till 2018, guess what happened? The Vanguard Dividend Growth Fund smoked the Wellington by $37,000. And it beat the S&P 500 by $20,000. So even though it took it on the chin pretty heavily, a lot less so than the S&P 500, but within spitting distance of Wellington, the facts are in 2018 it was up to $236,000, whereas the Wellington was only up to $200,000, and the S&P 500 was at $216,000. So we got three different time frames. 1993 to 2018, S&P 500 and Wellington basically spitting distance of each other. 2000 to 2018, Wellington by far was the best, with the Vanguard Dividend Growth Fund not quite a close second, but definitely second. How about 2009? So let's just say we invested $100,000 each after the market chaos, and what we'll see is S&P 500 reigns supreme again. Up and down and back, right back where we started. S&P 500 is up 3.5, basically tripled, 3.5%, 3.5 times. The Dividend Growth Fund is up, basically tripled, and the S&P and the Wellington is just doubled, a little bit more than doubled and a half. So, yeah. What do you do, man? That's what I'm talking about. Actually, let's just look at the performance of the Wellington going back to the last 10 years. We got 10, 3, 12, 20, 10, nothing, 11, 15, negative. All right, so we got 20, 12, 11, 9, 10, 32, 12, 3, 8, 19, and then a positive return. And then the S&P 500, 15, 2, 16, 32, 14, 2, or 1, 12, 22, and then down. So I'm telling you, the bonds are holding the Wellington back as we go forward. There's just no getting around that. I don't know what that means going forward. I don't know. But anyway, you can see here that at the end of the day, it depends on how you invested, when you invested to make it, which one was correct, unquote, right, or quote, unquote, right. So how to predict the future? Well, first and foremost, you simply cannot predict which investment will perform best in the future. You must admit you have no clue. You've got to. Should you even look at past performance as your guide? Probably not. Why? Because kind of like how climate change alarmists cherry pick the data to prove warming, you have to make a determination of what year to start your past performance research. Start in 1993 and the Vanguard dividend growth looks like a dog. Start in 2008 and the Vanguard dividend growth smokes them all. 1 year later though, and the S&P 500 is right back. You gotta be careful not to cherry pick. So why focus on 1 year as opposed to another? It's all in the past after all. So to choose past performance based on year X over year Y is inherently data manipulation. It doesn't mean it's nefarious. It just means you shouldn't do that. However, one of the best reasons to own Vanguard mutual funds or ETFs is because the simplest, most proven way to predict future performance is in the fees you pay to invest. The lower the fees, the better your performance will be. And all these funds have incredibly low expense ratios and very high tax efficiencies too. Tough to go wrong in that regard. Another thing to consider is that the Vanguard dividend growth only has 41 stocks in it as of September 2019. So it's a very concentrated portfolio. And if you want to outperform, you need concentrated portfolios. When that area of your investing focus takes off, you'll do way better than a broad and diversified portfolio. On the other hand, when that area of your investments gets hammered, you're going to get crushed much more, as that's just the nature of a concentrated portfolio. More up and more downside. A portfolio built solely on Amazon way outperformed. A portfolio built solely on GE got destroyed. Concentration equals risk. More upside, more downside, no two ways around that. Remember though, there's nothing wrong with saying, you know something? I like all three funds. Let me throw a third into each. That's probably the best path to take, and one ultimately I probably will once I hit the retirement time. Now, be advised, as I said at the beginning, I do own VDIGX. I don't own the other two. My other holding is just VTV. That's it. So just be advised. But anyway, this will be on the website, so I hope you enjoy it. It's going to be tough to go wrong, in my opinion, with all three of these funds, but I'll let you make that decision. All right, thanks, guys.